Access to this webinar is for educational and informational purposes only. Consult a licensed broker and registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account pricing and returns may differ from actual trading results. Commission costs are excluded. Neither BuildStockWorld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. How's everybody doing? All right, we mute everybody because everybody makes little rustly sounds and stuff. You can't help it, I guess, when you're sitting at your desk for an hour, you're going to end up making noise. So that's what we do. We mute everybody's things. Let's see. What are we doing now? Well, first of all, let's see how much money I'm losing. That's a good one, way to start. All right. So the Dow's right at 21,100. I'm already shorting the NASDAQ I'm shorting the Russell. And I started shorting the Russell, around here at 1420-ish. And I'm up to 15 shorts now. So my average is now 1421. So I'm going to start actually earlier than that. And I'm supposed to add more at 1430. I didn't catch it yet. If I add 5 more at 1430, I'm going to get 1/3. Adding a third, so I'm going to get 1/3 the difference between 1421 and 1430. So I'm basically going to get 3 more points out of it if I add 5 more at 1430. If I add it at 1428, I'm going to get 1/3 of this 7-point difference, which is like 2 points. It's not really worth adding. It's hardly worth adding the 3 points, but that's the line that theoretically we should stop at. So I don't mind adding more here. There's no reason to add it here. So I'm waiting for a good time to add a few more. I have pretty good conviction on this one. Also, oil. Where's oil? So as a brand new play, though, I certainly like shorting the Russell up here at 1429. I think that's a good short. It's 28.2 at the moment. On oil, I'm losing my ass also. Let's see, $750. I've worked myself up to 5 contracts now at the $49 line. My average is 48.85. But that's obviously very obtainable on a pullback, so nothing to worry about yet. And it's the same thing. I started out at 75, and I did start out with 2, then I added another 1, then I added another 2, and so now I've got 5. And each time I'm sort of raising the basis a little bit. And at the moment, 48.85 is even. And if I get back to 48.85, which is only here, then I pair back to 2 short contracts, and then I've got a higher basis than I started with. Same story here, except we haven't had a pullback. What happened is the Russell kind of made this giant leap up and hasn't pulled back at all, really. So I have not had a chance to pair that position down. The NASDAQ, I like the NASDAQ short here, the 6,000 line. And look, the best way to short this, maybe we can try this afternoon. The best way to short this is short it at the 6,000 line, and if it goes back over, as it crosses under right now, see? Now, if it goes back over, so here's your example. So we're in at 599.75. If it goes back over, get out. So if it goes over here, which it's doing now, then you'll get out and take a loss. And like I said, you don't do it the second it goes. Then you don't be the first idiot to get out. But if you see it moving up, you say, okay, I guess that was too early. And now it's going back down. So it's kind of shaking around this line. So we're just watching it. If you see you're talking about $5, $10, $20, it's not a big deal. Just keep your eye on it. Don't let it get away from you. All right. Meanwhile, when we get a nice little move down, then we'll hit cash. But it's good because these lines, if you see this line starting to firm up, you can stop worrying about it. You know, if you see like 6,000 becomes a ceiling and it can't get back over it, then you don't worry about it. If it is getting over it though, which it's over right now, so here's a stopping point. If it is getting over, then your premise is blown. It's not going below the 6,000 line. All right, so as it looks right now, it's not really performing. It's not really getting to the downside. I'm looking to do a downside demonstration though, so I'm kind of holding on to it. You see here, it's $15, $10, whatever. It's not a big deal. Just keep your eye on it and don't let it get away from you. But we assume that the 6,000 line will get rejected at least a bit of a pullback, and the pullback so far isn't significant. Now, what do we got here? We have the S&P, and we have oil. We're watching that. And we'll get the Russell up here. Okay. Now we're at 50. We don't like that. Here's that 25 stopping out line. Now we're over. Understand, we're over the stopping out line. When I say stopping out, I mean watch it at that point and get ready to stop out. It doesn't mean stop out the second it hits it, or you'll just basically stop out of everything you ever play. You know, futures jump up and down pretty significantly. Look, I made $1,000 on the Russell while we were talking. I mean, or I lost. I reduced 1,000 of my losses. Put it back. So we're going to watch this and see what happens. But what I'm looking for is I'm expecting at this point, and that's based on my premise that things should be calming down in the afternoon. I'm expecting that it'll fall below the 6,000 line and then stay there. And then once it stays below there, we have a better idea that it's going to keep going down and give us a nice drop. And then the question is, what are you going to be satisfied with? You don't want to predetermine it. You want to say, I got to watch all the indexes, and if they're all looking weak, I'll stay in the trade. If that changes, I'm going to get out. So we're hoping to get a drop back to test this 85 line over here. That'd be nice, right? Because that's going to be $15,300. So I already know that the $300 is the most I expect to make before it bounces back. And I'd be thrilled if I make 100, frankly, on a trade like this, because it's just a quick little trade that you're playing for a bounce off the resistance. All right, and as a rule of thumb, the 5% rule, even on a time frame this small, you can apply the 5% rule. We have a move from 85 to 00. That's 15 points. Now, 15 points means you would get a 6-point overshoot would be a move over. So that brings you up to 606. That's an overshoot. See how that is? That's an expected overshoot on a move like that. But then it failed at the overshoot 1, 2, 3 times. So if you think it failed 3 times at the overshoot, it might come back a little bit further. We did get, obviously, a big pullback here. So first attempt fails. Second attempt, same overshoot. Coming back. If anything, I would expect it, if it's going to be stronger, I would think it would pull back under, like this did right here, pull back under about halfway to 97.50. Not 97.50, 85 to 92.50. So we'd be looking for like 92.50 right about here as a pullback, realistically. But again, that's assuming that we get the dip we expect and there's weakness and so on and so forth. So we'll just have to wait and see what happens. All right, but I mean, this is how you play the futures. You put a little one in, you get a tight stop, you watch it. If it goes well, you're going to make $300 or $150. If it goes badly, you're going to lose $20, $30. So obviously, if you're only going to lose $30 and you're going to make $150, you only have to be right 1 out of 5 times to be even. And it shouldn't be guessing, though. You should have a premise and say, I think the market's overbought. I think it's going to sell off. I think that in the afternoon we have this and that catalyst or whatever. That's the kind of stuff you got to have. You can't just randomly short things and randomly go long. Then you're just playing roulette, and that's not a good idea. Although again, if you manage your money well, the difference is that unlike roulette, which pays you the same whether you win or lose, right? You get you bet black or you bet white, you're going to lose, and then there's a house advantage. There's no house advantage to betting the future. So as long as you manage your money well and intelligently pick spots where you can see a nice spot to fall here and very little room for it to go up until you're going to stop out. Well, I should have stopped out already. I'm down $25. So right now this is not working out. So I'm only going to give it one more chance, and if it doesn't start behaving itself, I'm going to get out of it. And we'll try it again later. I'm going to show you exactly what I mean about these things. But right now it is not working out. So it just persistently, instead of 6,000 being a ceiling, it's being a floor. That's the opposite of my premise. So here I'm down $20. So it's not emotional. I'm not married to the position. It's just something I wanted to demonstrate. Here I'm down $20. Here's back to my stopping line. One more chance. You bastard. Would have been nice, right? Come on. Oh, that was encouraging. But 6,000 is holding. Now, of course, 6,000 is going to hold when it's coming down. It's going to take a bit to break through something like that on either side. We had hoped it would take a bit to break over the top. Now we're back on this. Okay, so now this is the last chance. If it goes back over, I don't want to hear about it. But see that number here, 28.7, that's encouraging. 23.8, 26.3. See, this is encouraging. There seems to be more sellers than buyers. But here, 11.5 all of a sudden. 24.8. Oh, these might be sneaky sellers. 19.1. They see they're not putting in big orders, but they are relentlessly selling. They don't want to show their hand. 30.10. 28.11. Oh, sneaky buyer came in. That's it. Then I'm definitely going to stop out. Now I'm up $10. I can lock in a profit. Nope, not anymore. Come on. I mean, I already, from my perspective, I already have the TF bet, so this isn't very exciting for me. But all right. So anyway, so it's not working, or it's not really working. But we're making a little bit of progress. And now I want to. So since I'm not sure, now I want to double check the Dow, which is usually pretty sensitive, and see if the Dow's failing anything good. Not really. The S&P is sort of hovering here, but coming down a bit. But nobody's really failing any good lines. I'd like to see the Russell fail this red line to encourage me to hang on to my NQ short. See, now when the S&P gets here, now here's the other thing. When am I going to stop out of this? Well, when the S&P gets here to this pink line, that should be support. It's probably going to bounce. So I've only got 2 S&P points before I hit a probable bounce. And so I know that means that it's closing in on me, and the Russell is still holding on to its line, so it's not looking very good for this. It's hard to expect a strong winner out of this thing. So basically at this point, even if I get a win, I'm going to still get bounced out here, just 2 S&P points lower. So it diminishes my chance of having a big win. So if I don't think I'm going to have a big win, what's the point of staying in it? So back to our stopping line, and what I say before, now you have to have discipline. I said if it gets back to our stopping line again, I am going to get out. So unfortunately, we'll say goodbye to this thing, I think. All right, so that's a dead trade. We're down $10. We'll take a look later and see if we get a better setup. But that one did not work. supercalifragilistic, and you get tired writing it. All right, so where are we? Oh, okay, one of the things I wanted to do today, since nobody's asking any questions, is let's take a look at, it was very disappointing though, I'll tell you. Spoiler alert, it's not one of those things where, if you stay for the next 10 minutes, I will show you. No, I'll tell you right now, I was very disappointed researching metal stuff, for batteries. It turns out for nickel, it's really Vale and BHP, and then Vale is a $56 billion company, and BHP is a $113 billion company. And today, we were looking at the chart, nickel is a $21 billion thing. So, not knowing the exact breakdown of each miner, because I didn't go that far into it, but if we look at, maybe it'll say though, if we look at BHP, how much of the world's $21 billion nickel market does BHP have? I have no idea. I was hoping they would have a report on them. Sometimes Thinkorswim has a report. Oh, company profile. There you go. Okay. That's not very helpful. All right. So we don't know how much of this is base metals, how much of that is nickel production, blah, blah, blah. Anyway, but nonetheless, in a battery, there's a good amount of nickel. And so BHP and Vale are both companies that do that, but it's not a very big part of their operation. So it's not going to give us the kind of bump we want off of that. We really have to look more into what do they do for a living? It won't be a bad thing for them. That's one thing, But what do they actually do for a living that we should count on? So BHP, not a cheap stock. Vale, also up there in the channel. So it's basically trading at highs. Now we go back and we look at them and they say 20 PE on BHP. I'm not getting into double checking it, but I'm just saying. And on Vale, seems more reasonable, 15. So now I want to look because I'm interested. So 15, they've got irregular sales, irregular income, kind of crazy. It's the kind of thing that makes you want to now this is interesting, they only make 650 there, then they make 12 billion, lose 12 billion, then they make 4 billion. Now, the good news is though, when you come in off a loss like that, one thing you know is you're not going to pay any taxes. There's no tax on earnings until they make this 12 billion back. That's nice. Let's see if that shows up in the financials. Interest expense, income tax expense. I don't know why they have an income tax expense here. That makes no sense to me if they lost that much money. Seems odd. Although apparently they already took, they already took a $5 billion credit last year. Gosh, did that use up all their stuff? Who knows? That seems interesting. Anyhow, so having not checked that out, but anyway, so at least Vale's got relatively interesting that possibly they could do better. They are pretty up there, but they're a cheap stock. It's just horrifying that they go from 850 to 2 to 11 to 7. I think on the whole you really want to wait till it's back around 8 at least to see what happens. But it seems okay. Let's put it that way. It seems like if you want to bet on the growing world and more use of nickel and so on and so forth, Vale's not a terrible bet. The other ones were all penny stocks. You got in lithium. Well, not all. I'm sorry. You have ALB in lithium. And they're not bad. What's their profile say about that? They're a specialty chemical company that, for whatever reason, part of their operation is lithium. Now, again, though, it's the same problem as Vale or BHP, though. They're big. They sell $2 billion worth of stuff. They make reasonable money selling it. Wait, I'm sorry, that's not their income. They make reasonable money selling it. It's been going up. They're a growing company. They seem like a nice thing to play. But I would call this a lithium kicker because they're not a pure play lithium. But on the other hand, you say, well, it doesn't matter. If people get excited about lithium stocks, they're still going to go up to 20, which is going to be a 25% increase from where we are now. All right, so you take a look at ALB. And see how far. Oh, so we can go reasonably. See, they do have 2019, so that's nice. And they're at 125. So what you can do is you can discount it for yourself. Let's see where they got really good support. Let's see if they have really good support. Okay, so somewhere around 85, they should have some nice support. They had good consolidation at 85 before breaking up. And that was a double. Makes sense, right? They start at 47, double with 85, consolidate at the double, then pump 50% from there, probably on the way to that 20 PE, and that's going to bring them right to about 170. So they got a good amount of room to run. 150 to 165, I'd say, is a good room to run for these guys. I like that. The problem is their options don't seem to pay very much. But like I said, we're very happy to pay 85. We know that, so you can sell those things and not worry about it. If you want to be more aggressive, you could sell the 90 puts for like if it's 480, that'd be great, but I doubt it. It says 390, 470, so figure what's in between that? 430. So let's say you sell those puts for 430. Now, your worst case scenario there is you're going to own the stock at 90. That's fine. It's like $35 off the price now. It's a pretty good discount. It's like a 30% discount. So your worst case is you're going to buy these guys at a 30% discount. If you want to get more aggressive to the upside, I would just speculate. I wouldn't go deep in the money because you can get burned. But if you take let's say the 120 calls, they're just about $20, 1960. So if you get these to 1960 and you sell the 135, because we're not being very ambitious here, for 1254, you got to be able to get 13 something for this. So say 1320. So if this is 1960 and this is 1320, you're only spending about $6 on the $15 spread, on the 120, 135 spread, minus the $4 you collect over here for the 90 puts, and you've got a net $2 entry on a $15 spread that's $5 in the money in the lithium sector. So that's a nice way to play. And like I said, your worst case is you're going to end up owning the thing to 90 plus the 2 you spent is 92. But I like that play. In fact, why don't we put that in the long-term portfolio? Because I do like that. That'll be a fun one to watch. Not a big position. You don't need it. First of all, you don't need a big position because it makes freaking 7.5 times what you put into it, as far as cash. So the question is, in the long-term portfolio, if ALB drops 30%, how much of it do we want to own? We don't want. I don't want 90,000. I don't want 1,000 shares. That would be a lot. So why don't we start off with do I want 500 shares? Do I want to have $45,000 worth of these guys? Yeah, in the long-term portfolio, I can deal with that. That's not so terrible. So, as a long-term portfolio play, let's see if I can. Okay, so we're going to sell. So 430, we're going to sell 5 of the 2019-90 puts. So, long-term portfolio. So here we go. From the sell 5 ALB in the webinar for the 20. So we're going to sell 5 of the ALB 2019 dollar, what were they, 90 puts? 90 puts for 430, and that's in 2,150 bucks. Then we're going to buy, well, we already know we're going to buy. We're going to buy, now what if we buy 10? What do we say, it was 6? No, that's no fun. That's no good. No, we're going to buy 5. ALB 2019 $120 call for mystery price, and we're going to sell 5 ALB 2019 $135 call for mystery price. Okay, so let's look at the prices first, and let's talk about what we're doing here. All right, so we got the 120s, and we said they're going to be $19.60. That's not even a good price. Call that 21, call that 19. That means 20 bucks. So realistically, it's going to be $20, and that's going to be $10,000. And then we're going to sell 5 of the 135s, and 1288 is not a good price for the same reason, so call this 1350, because they're right between the two. So 1350. Oh, got to do math. 1350 is what, 675? That'd be 6,750. All right, and that's going to be, that will be net 8,900. Okay, so that'll be net $1,100 on the $7,500 spread. Is that right? 5 times, yeah, half, 5 of 15, yeah. On the $7,500 spread, that's over 5,000 in money. It's just sitting into a producer. Interesting. Okay, so now keep in mind this is an entry play. First of all, the long-term portfolio is $1 million portfolio at this point. It's over $1 million. So we're not making a huge commitment. At the worst case scenario, we're going to own $45,000 worth of ALB. We're taking high calls because here's the thing. Rather than putting a lot of money into this thing now, I'm saying, okay, well, if it keeps going up, we'll end up making $6,400 bucks, which is whatever, 600%. So if it keeps going up, we're going to make $6,400 bucks. And who's going to cry about that? Even in $1 million portfolio, it's nice to make $6,400 bucks. So if it turns out that this thing goes straight to the moon and blah blah blah, we'll say, oh, I wish we got more and whatever. But the bottom line is we're going to make $6,400 bucks. If, on the other hand, though, it goes down, then it gets more interesting for us. Because if it goes down, then we would start looking at rolling. Possibly, not assuming we like it still. But the 90 puts we're not likely to be worried about. Plus, there'll be other years coming up and we'll be able to roll them. The 120 calls, though, again, let's say they're 21. What's 31? The 100 calls are about 31. So for $10 more, we should be able to roll at least at no more than $10. We should be able to roll the 120s to the 100s and pick up 20 in space. See, that's when we want to invest more money. If it moves against us, we're going to invest. Then we're going to start putting money to work to widen our spread. So we would put another. What do we say it's going to cost? $10. We'll put another $5,000 into the spread. Understand? Because we're going to go from here, 120 to 100 for $10 on 5 contracts, that's going to be $5,000. We would spend $5,000, and then we'd have the 100-135 spread. That's a $25,000 spread with the short 90 put, still nowhere near the money. And then we still got 2 years for this thing to recover. So honestly, that's a position we want to be in, but we're only going to go into it if it gets cheaper. That position can make us back $19,000 on $6,000, whereas the position we're in now can make us $6,400 on $1,100. So on the whole, and this is, by the way, it's an interesting thing. You manage people's money. You got to think like this. It's an interesting thing because if you have a lot of money, you want to put it to work. So, for very rich people, for high net worth people, it's not very exciting for them to have $1,000 put to work. And I keep trying to say, though, and I'm trying to show people in the long-term portfolio, these little $5,000 wins add up. How we make most of our money is on these little stupid wins. Make $60,000, $100,000 a year on that, plus $40,000 in dividends. And by the time you've done, my $1 million portfolio is making $150,000, $200,000 a year on these bullshit plays. There's nothing wrong with a bullshit play. We have tons of them. But should it get cheaper, then we pounce and we say, and that's why I call it like a placeholder, because I want ALB to be in the long-term portfolio. I want us to look at it and think about it, and then if it does get cheaper, that will then cause us to really analyze it very carefully, look at what's going on, why did it get cheaper, why did it sell off, and then we add to our position. Which brings me up to my next topic, if there's no questions. So let's put this in and make it official by making it bold and blue and indenting it. All right, so let's see if there's questions before I go on. Oh my God, look at all these questions all of a sudden. What are you guys doing? I was just going to go on to a whole new topic. What was my topic? Oh yes, getting more aggressive with plays. That's very important. Okay. Are we done with lithium though? I am done with lithium. No, not really done. I got a couple more lithiums to do. All right, let's do the questions first. Somebody remind me of that. I want to go on to look at the butterfly portfolio and stuff. Entry point for Apple 120, 145. What? I'd be very happy with 145. I don't know where you're getting these prices, but they give it to you. Actually, we sold. What was our Apple position? This working butterfly. Yeah, see, we have the short. So here's my target. My target was 155. And that's as of right before, knowing that we were coming into this thing. My decision last week was to sell very aggressively. Well, not very aggressively. So we sold 40 out of 60 of the 155 calls to 850. So I was calling the top of 160. I wanted to protect our long position, but I also, just in case I was wrong, I wanted to leave some room, right? But that's exactly, the net there is just about 145. So that basically was my prediction. Now, doesn't matter what the net, that net doesn't matter. I mean, sorry for the call. But I was calling the top, and it was more for the protection. Now, I didn't want to sell the 145 because that would be too crazy in the money. I wanted to sell as much premium as I could at the time. But that was our call on Apple, was that they will pull back at this point. And in fact, I think in the, it must be the long-term portfolio, I think I was even more aggressive with the cover. Nope, it wasn't. 145. Here I sold the September 145. Oh, I'm sorry. It was more aggressive, but we only sold 30 out of 50. So we're just locking in our gains. That was the point of this. The idea here was to lock in our gains. I wasn't trying to make money. I just want to protect what we got. And then in the options opportunity portfolio, well, they're doing okay. Here we sold 40. Now, these we were stuck in for a long term, but we didn't change them. We have 40 out of 60 of the September 140. So in all these cases, we've been pretty aggressive on Apple. We got a lot of changing to do on those. Anyway, so that's the answer to that question. Can you go over the NGZ play? I was under the impression that you were going to play this long and not take quick profits. Yeah, well, I always say that, but then if it, I don't intend to take quick profits, but if you shove thousands of dollars at me and say, what am I going to do? So, I mean, what? That's my brother. Why is that not? Hello? What's up? Oh, that's good. Hey, I'm doing a seminar. I can't talk now. No problem. Later. His power is restored. He's very proud. All right. Down in Boca. So anyway. It was a week ago, right? It was back around here. We played this down at 290. It went over 3. That's $1,000 a contract. So I took it off the table. Unfortunately, though, when it did this, I took it off the table. And this spike, I cashed. I didn't cash at 295 because I was in it for the long haul. But when it went up to 3, as I said that the other day, when it went up to 3, I got out. So I'm like, when it did this, I'm up $1,200, $1,300, $1,400 a contract. I can't stay in that and then see it pull back to here. I feel like a moron. And it certainly does do that, doesn't it? It goes up here, it goes down here, it goes up here, it goes down here. So I'm not going to sit there and ride that out. And so I got out. Now, I missed this, so I'm not in that. Now I'm not even in. Because it popped up too fast for me. I was hoping it would come lower, and I'll get back in at 295. If I get out here, even if it goes to 295 and I get back in and then it goes to 290, I'm still ahead of the game, right? Because I got this money in my pocket, minus I'm only losing a nickel on the way down here of it. So I'm always going in and out. I'm just sitting the gas on. I'm sorry, not always. I'm going in and out because even though it's a long-term contract, when it makes 10 cents in a day, and I get $1,000 per contract on 5, 6 contracts or whatever I had, I can't not take that money. I'm not that rich. I wish I was that rich. I wish I didn't consider $5,000 or $6,000 a day to be big money. But that's just the way I am. I can't shake that. I came from nothing. I still think that's money. But on the other hand, look, when I'm looking at it long like that, my basic, the concept I was trying to convey here is that if it goes lower, I'm staying with it, and I'll add to it because I have conviction. I'm going to go long term. I don't know when it's going to pop, but if I can't be happy that it goes from 290 to 304 or whatever it was, forget it. Then you shouldn't be playing. I mean, that's a 5% move. 290 to 305 is 5%. You've got to be happy with a 5% move in a commodity or you shouldn't be playing it. That's huge. Oh, speaking of which, how's the futures doing? Still at 6,000. That's good, though. I like that now. So let's go back in. All right, so now we're going to make attempt number 2. Why do I like it? If it's still weak. All that time we've been talking, this thing has made no progress at all. I guess it went up a bit and went back down. But it's still weak, so it's making another attempt to break through. So I like it again. So I'm going back to the one short, and we're going to see how it goes. And by the way, obviously, I'm conviction here myself for my own personal stuff. I got my oil lows. This is me demonstrating how you should play when you're learning how to play. You should play very, very timid, very small, and it's mostly about getting a feel for how this thing moves. It's practice, practice, practice. So I feel better about this one than I did about it last time because we're making another attempt. We had another failure up here. It just does not want to go higher. So now somebody's got to get brave and see if it's going to test lower. So let's see how this plays out now. And I'd really love to see the Russell go below here for my own purposes. See how that works out too. All right, back to what we were talking about. What were we talking about? Oh yeah, we're done with that, right? Definitions do you have? What? How many long definitions do you have? Anyway, so I got none now. Even contract. What would be a good spread now? It was pulled back to 14. I don't like them. I don't know why you guys are so fascinated with them. They're a bad company. They've done horrible things. They made a mess of themselves. I don't know. It's just not for me. I mean, they pull back to 14. They're from fucking 200 and they're from 200. And you're worried about the range between 10 and 20. It's just not a thing I care anything about. I think it's a complete gamble. But if you want to play them, your premise has to be that they're righting their ship and they'll turn it around and that probably their value is a quarter of what it was, not a tenth of what it was. So therefore, you say realistically, well, gosh, they got to be worth $50, and so let's even cut that in half and say 25, and then you say, okay, fine. So 25. If you are at all bullish on them, you've got to go for 25. And so, a not terribly risky play would be to go VRX. And again, they could go bankrupt and you'll get nothing. Keep that in mind. They could ultimately find out they're not a going concern. But look, you got 2020 calls. Gotta love that, right? Roll out the 2020s. And they're trading, so good. All right, so in 2020, you can buy, they're at 14 now, you can buy the $12 calls for 606. Let's assume the last is a good price probably. So let's say you spend 606 here, and you sell, well, look at this. I mean, you can sell the 22s for $3. All right, so you pick up the 12-22 bull call spread for 305 or 306, and that's a $10 spread for $3. That's it. I would not short puts. If you hit this, you're gonna make $7 on $3, which is 230%. So why would you do anything else? Why be risky? Why be crazy? Why take chances? How much money? So now you say, how much money am I willing to lose on VRX? So if I had a $100,000 portfolio, and I thought this was a good play, I'd say, well, it's a biotech, it's a pharma kind of play. So in that context, maybe I don't want to allocate more than maybe 10, 15,000 to the sector, and I wouldn't want to make this more than 20% of my allocation of what I could possibly lose. So you're going to be looking at maybe $2,000, but the $2,000 can become $10,000. I'm sorry, $2,000. Well, in this case, since it's $3, I would put $3,000. So you said, let's say you do $3,000, do 10 contracts for $3,000. So the $3,000 can bring you back $10,000, and you're going to make $7,000. That's a pretty good bump to your portfolio, and it can't hurt you by more than 3% of your portfolio, even if it's wiped out. And if you put a stop in at $1.50 and say, well, if it gets to $1.50, I'm probably wrong. So you put a stop in at $1.50, and now you're only risking $1.50 to make $7,000. That's the way you play it. So hopefully, unless they suddenly go bankrupt on you, you're gonna basically only risk $1,500, even though you're laying out $3,000. You're gonna only risk half of it, and your reward potential is $7,000. So for something speculative like that, that's how I play it. And you're being super conservative If they survive for 3 years, I gotta think for 2 years, I've gotta think they're gonna make it back in the 20s. Otherwise, why are they surviving? So that's the logic I would use to play something like that. What we do with CCL October puts you suggested with the hurricane. Creedence Clearwater? What? What do they look like now? Oh, it's Carnival. What was CCL was? Well, they worked and now they didn't work, so I'm not sure what your timing was because they were fantastic at first. If you didn't get out of them, that's the end of it. I mean, the hurricane's gone and the premise is over. But what is this? Sign up, login. Why do you not know me? Oh, come on. My account is expired. What is that crap? They stole my identity. Freaking Equifax. No, actually, I'm going to find out what that is. No, that's weird because it's working on my other machine, isn't it? Wow. Is that Carnival? No, it works on my other machine. Weird. Anyway, all right. So the bottom line is we had, when did I say this? Last webinar? Because we never officially put it in a portfolio. It's just something I mentioned, I think. But 1, 2, 3, 4, 5. So I don't know. We talked about it like last week on, what was Wednesday? What was last Wednesday? Oh, it was the 6th. Okay. So I think it was after this. So I think we talked about it here. It had a little dip, and it went back on. What were those puts? Did you write what those puts were? October puts. No, the point was it was for the hurricane, and it went down, and it made money, and now it didn't make money anymore. Oh, no, don't tell me thanks. Ugh, CL jumped to 49.35. Bastards. Charts. I'm not charts. Trader. Okay, we weren't watching that at all. That's going to hurt. Wow. Now, I don't want to do anything until we get to the NYMEX close, but that is really... So where's the two? So here's the question: where's the 2.5% line for the day? It's going to be up around 49.50. So the NYMEX closes at 2:30. We're going to want to keep an eye on that and see about shorting it into this end. So I will be adding some more contracts on that one. I just wish that one of these guys was paying off, but neither one is paying off at the moment. Not even my NASDAQ. It's still holding the stupid one. All right. Well, thanks for telling me, even though I'm not happy about it. So what were we talking about? Carnival. Oh, yeah, so anyway, Carnival. It was a quick play. When we just find a put like that, it's just a quick play. When you make money and you get out. I don't remember what the October puts were. Did you write it? October 60 puts. So, product, KCL, here's the 60 puts, which are now nothing. That's interesting. Okay, put chart. Nope. Copy. And then I want to go to charts. Grid. Okay. What the hell view is this? 10 days. Okay. So where were we? So last week, they were 50-something cents, 55 cents, let's say. They went to 70, which is not very exciting, frankly, but still you got to realize 70 is a 15-cent gain on 55 cents is more than 20%. So it popped 20% into the hurricane. I'm sorry, not into the hurricane. Wait a minute. This weekend seems like so long ago. Yeah, it was this weekend. Holy cow. Okay, it seems like it was forever ago. My brother just got his power back, so I guess it was this weekend. So into Friday, we got a pop, and then it went down quickly. So even on here's Friday. Actually, it came back down Friday. I understand if you stayed in that because it wasn't very sad. The game wasn't satisfying, and then you stayed in. But then obviously the destruction wasn't what we thought it was, and it starts coming down. But at that point, you got to say, okay, my premise didn't work. There wasn't enough destruction to really damage anything. So now it's down to 30, and it's essentially a losing trade at this point. It wasn't supposed to be a long-term play. It was just a play based on what was happening in the news. So I wouldn't say save it or do anything special with it. It just didn't work. Sorry about that, but it just on the whole, if you didn't catch that move up and take the money, it's just basically a trade that did not work out. When you say $5,000 in the money on ALB, please run through the math on the trade 75 cents for the spread. Oh, did I say 5,000 money? Sorry, it's $5 in the money, 2,500 in the money. Sorry, there's only 5 contracts. So I was looking at $5 in the money, and since I almost always do 10s, I didn't think of it that way. What's up with Amazon? Isn't it going to dump? Oh, did I write that on the thing? 2,500. Math, my mortal enemy. Okay. What's up with Amazon? Isn't it going to dump? Eventually, you would think, but who knows? Small caps are moving over 60 clicks. All right. So, small caps are moving. I don't like the way that sounds. Go back to my thing. You're so annoying. No. I wasn't paying attention. Everything's going up now. It's terrible. So unfortunately, a lot of it's the market's being driven by the recovery in oil, so we can't stay in this. Now we're down $65. It's really annoying. Nope. $65 down. That is not going good. And it's 2 o'clock now. Got another half hour of the NYMEX. Let's look at, all right, so let's practice something else. Let's take a look at Twitter and see if anything's been happening in oil that we should be concerned about. Twitter. Oil. Just in general. Just give everybody the finger. Okay. So anyway, today is a day when they've done several things. In addition to the Saudis saying they're going to cut more production, they had the IEA, the International Energy Agency, raise their forecast for demand, which honestly there's no sign of whatsoever, but they're raising their demand forecast. So there's a lot of effort being made to punch up the price of oil. Oh, man. That sucks. Greece got a huge oil spill. That's all they need, right? Oh, that's funny. I show up here. I guess that's good if you put oil in Twitter, my article shows up. Anyway, that shows there wasn't very much news today, was it? So I don't see any other new news. So being that there's no new news, that makes me want to add some more. So I'm not going to add a lot. I'm going to add one. That takes me to 48.90. I'm going to add another one so I can get over 49. Oh, come on, 48.96. Damn it. We'll want to go for 3? Yeah, why not? Okay, one more and I should be over. Yeah, 49. Okay. So you see what I care about? What I'm watching is here because that helps me. Because now I can stop out at 49, get back to 2 or 4 short at 49, and I'll be even, but with a nice high $49 short position that I wouldn't have gotten. And don't forget, I started at 48.75 this morning. So it went my way fit first. I didn't take the money. When it went against me, didn't stop out. Added a couple more over here. Got up to 5. Now it went against me again. I'm up to 8, but I've moved my basis up to 49. Now, why is that? Because my original premise hasn't changed, that I think that this is being manipulated higher today. I don't know how high they can force it, but I do know that they might make a push into the close of the NYMEX, which happens in 30 minutes. I want to be short. I want to be short now. I don't see anything else they're going to be able to do to push oil higher than this. And I think that over the next couple of days it will come down a bit. And certainly, like I said, by next week, see, that's the thing, I have conviction all the way into next week, because as we discussed this morning, they are swimming in contracts. This is a strip at the NYMEX. And look at the turnover here. You have 300,000 contracts turning over 170,000 tons. 50% turnover on these contracts. It's such complete nonsense. And on the 20th, on the last day of trading this contract, there will be no more than 15,000 actual contracts. So here, so 285,000 of these things are fake contracts. It's sick. It's a sick joke. And anyway, so there's that many here. Look at, they're already stuck here. And not to mention the fact they have to get rid of, if they want to get to 385, they got 300,000 to get rid of in 6 trading days. Is that right? Today, 6 or 5? One, 2, 3, 4, 5, 6 days, right? Okay, so they got 6 trading days to do 300,000 contracts. That's 50,000 contracts a day. They have to either shove into one of these front months, so they're going to roll their trouble down the road at a cost of 50 cents, or at a cost of almost $1, at a cost of $1.25. That's per barrel. So this is 300 million barrels. So this, to roll it to here, will cost them $400 million. Not obviously they're not one group, but as a cumulative group of traders, that's a lot of money to lose. Even though the bigger picture is all they're doing is jacking up the prices for the big oil. So believe me, the big oil companies, at least the guy at the gas station who's selling you gas for $3 a gallon right now, is thrilled with what they're doing at the NYMEX for him. So this is just basically milking any excuse to jack up the price of oil, even though there's no logic to it. Because not only was there this massive build in oil, but the shipping channel was disrupted by the hurricane, so less oil was imported. It did not have a huge impact on exports. The exports are just basically backed up for 2 days, 3 days, and now they're going out. So our exports are 2.5 million barrels a day. That's 7.5 million barrels. Let's assume they were all backed up, but that's not true. They go out of all different ports, not just one port. But even if we backed up 6 million barrels a day, the imports are, well, let's look at this thing. Petroleum status report. Okay. So, big. Okay. So look, we import look at the exports. The exports are lower than I thought. They were 1.4 last week. That's because of the disruption. But you can see, in fact, you can see the effect. It only lowered our exports by a little bit. It only lowered our imports by a little bit. We import so much more than we export that the net doesn't matter. Look, 5444 net, 5460 net. There is no effect on the net daily imports of oil. And we had a 6 million barrel build in oil. Wait, where is that? Gasoline production, oil production, import. Oh, here it is. U.S. commercial inventories increased by 5.9 million barrels. That's in 1 week on the same net imports. How is that a demand picture? Now, product supply, well, it turns out for all the complaining, the product supply was pretty even. The refineries supplied about the same amount of product. So that's interesting. And that's through 9/8, which was before the Florida storm, but after the Texas storm. That was through Friday. So, bottom line, building oil, drawing gasoline, and again, it's more so, it's not because they didn't produce gasoline, it's because in Florida, everybody filled up their tanks and caused a shortage. That's the main reason. Also, as Texas, interestingly, as Texas is recovering, everybody's filling up their tanks because they couldn't get gas during the storm. The refineries were down. So for some brief amount of time, so the people who didn't get their oil during the first storm, during Harvey in Texas, they sucked up the gasoline that was being produced by the refineries. Then Florida gets hit, and all those people ahead of that storm go to pull out they're putting gas in their tank, which uses up the capacity, causing a draw on gasoline. That's going to completely reverse. This is a one-time thing, and people are going crazy about it. It makes no sense. Distillates, down a bit. All other oils, check out this. Check that out. All other oils up 8 million barrels. So once again, they started producing random, they purposely produced things that didn't go into inventory, that don't hit the headline inventory to make it appear that more was being used than it was. They could have produced gasoline knowing that it was being shorted, but they didn't. They chose to produce more other oil. It's a choice the refineries make, what they're going to produce. The SPR, they took about 1 million barrels out of the SPRs. We were short on stuff, and that's a good thing. And they've been selling off the SPR anyway. It was $695, now it's $677. They've been to raise money. Trump has been selling off the SPR, which is ridiculous. So that's where we are. Anyway, so that's why I'm short. There's nothing in this report that makes me think there is a demand picture. There's no indication that there's more being used. Last year, we had 9.5 million barrels a day of gasoline. Now it was 9,543. Now it's 9,564. The EIA says that it's going up 1 million barrels a day. Where? That's what the EIA report says. It says there's going to be 1 million barrels a day more used, mostly in America. 1.5 million worldwide, but most of the gains were from America. Like where? Why would people think? But you know what it is? You tell it to someone in China, you tell it to traders in Russia and China and Japan, and they believe it. They're like, oh, America, yeah, they're huge. They could suck up 1 million barrels of oil a day. It's not true though. We don't need it. The only thing we're doing with oil is exporting it. We are not using more oil. And you've got and also check this out. How many cars were destroyed in Texas? 500,000 cars. Of those 500,000 cars, probably 250,000 of those cars were old cars. So here's what's going to happen. And Florida, so who knows what the total number is. But let's just say, for example, 250,000 cars that used to use, that used to get 30 miles a gallon, and let's say 15, how many miles do you drive a year? 15,000 miles a year. At 30 miles a gallon is 500 gallons, right, a year. So they used to use, they used to use at 20 miles per gallon. Sorry, my mistake. At 20 miles a gallon, they used to use 750 gallons. Now, it's not 30, it's 35 anyway. You can't, if you buy new cars, they have an average mileage of 35 miles per gallon. So that's a law. That's what the fleet average has to be. So car companies that have to sell Texas people 250,000 cars can't sell them all trucks. The dealers actually have to work hard to convince people to get more environmentally friendly cars. Because their fleet average has to be a certain amount or the government fines them. So you have to put all kinds of incentives to get people to buy more economical cars. Plus the trucks are more economical. But let's even say it's 30, okay? So now you have 250,000 people who are going to use 250,000 cars that are going to use, super conservative these numbers, 250 times 250 less gallons of gas. Okay, so they go from going from 20 to 30 miles per gallon on just half of the cars that are being replaced by the storm, and that's 62 million gallons of gas. Then we divide that by 40. And that's 1.5 million less barrels of gas, which is not huge. It's only, in a week, it's 300,000 barrels a week. Wait. Divided by 52. Sorry, 30,000 barrels a week. But just that little incident is going to knock 30 off that number. As those cars get replaced. Now, meanwhile, those cars aren't replaced. They're unusable, and there's nobody using any gas this week. But over the course of the year, and I'm being super conservative, I think on the whole you're going to be knocking off probably 100,000 barrels of gasoline less consumption because of this incident. So rather than our consumption going up, it's going to go down. And you know what? It'd be a fantastic place to do a study. I would love to do a proper study on the gasoline consumption in Texas pre- and post-hurricane, because you're just forcing all these people to turn in their cars to get higher mileage cars when they get new cars. It'd be really interesting. But the bottom line is, how does consumption go up? It's dead stopped right now. People just physically can't move around like they were, so they're pretty much staying where they are. People are staying home fixing their things. They're not going to work. The jobs are closed. FedEx isn't delivering. All kinds of the airports are closed. All kinds of stuff like that. But in Florida, first it was Texas. They're getting back on their feet. Now it's Florida. They're going to be down for the rest of the week. My brother just called me and said he got his power back. This is, days later. He's not working. His office isn't open. My mom went to the what do you call that thing? Publix, the supermarket. It's right on. She got a supermarket right on the corner of where she lives. They are. They were like half the people. First of all, they were half staffed because people still couldn't get in. They had. She said the shelves were bare. Probably a third or half of what there normally would be on the shelves. And everybody's just making do with what they got. But that's an economy that just ground to a halt. So they're using less gas for a week, and Texas is using less gas for a week. And these are big dents that you're not. We obviously saw what you see here is people running in and jamming and filling up their tanks ahead of a catastrophe. Plus the people, like I said, the timing-wise, these guys, Texas was filling up their tanks after the catastrophe when they get their gas back. Florida never really lost gas, but because they all ran upstate, which was not stupid, but they all ran away upstate, they all filled up their tanks, ran away upstate, but it's not that far. They only went to like Orlando and Georgia. It's not a huge trip, so they still got most of that gas in the tank, which means they're going to come back. They don't need the gas. So next week, I predict a serious build in gasoline, especially if these refining numbers hold up and they're still producing the same amount of gasoline. All of a sudden, you're going to find out that none of these gas stations actually want to fill up their tanks because they just don't need it. So anyway, that's my premise. Not working so far, but we'll see. How's he doing? He's doing okay. That just does not work. All these guys, this is terrible. Getting killed. See, and overall, the S&P is it's down a tiny bit. It's in the red, and the Nasdaq's in the red. I'm the only idiot with the only the ones I bet on are positive right now. But anyway, so that's why I have that premise. And especially as we're heading into the rollover next week, who's going to want this oil in October? What are they going to do with it? So I expect actually an oil, I expect a pretty sharp sell-off. I expect a nice dip, probably 47.50. And I certainly want to be there when it happens. So you have open shorts on TF. You got out of NQ. Why are you still in TF? No. The NQ was a demonstration play to show how you go into a contract and get out. I wasn't going to demonstrate with I'm not going to mess around with the 10 I have. Those I have conviction on, though. That's my own private playing. That's not for the purpose of me teach. It's not a teaching one. That's how I'm actually playing the Russell right now. All right, so this is just what I have open, and that's just what I have open. Although as I just said, I very, very much like this trade as a short right now. Meanwhile, the indexes are punching up. Choice. Look at this. Everybody. They're going to try really hard to get the Nasdaq and the S&P green, I guess. And by the way, nothing really is going to change necessarily until the Fed next week. So, everybody thinks the Fed's going to stay on hold. So meanwhile, what can the Fed do? They'll be on hold. People think they're going to be on hold. They'll be on hold. That's the best case scenario. The worst case scenario is they're not on hold, and everybody's going to freak out. And they're going to say, well, if even a hurricane can't stop them from tightening, I guess they're serious. So we'll see how that works. All right. Oh, back to nickel. Let's go back to nickel. Back to whatever I was talking about. What's your premise on NG? NG is just because we're exporting more and more natural gas. That just keeps increasing over time, and that's going to cause over the long haul, the price of natural gas in the U.S. will sort of equalize with the price in the rest of the world. And I think right now obviously in the U.S. it's $3 a billion cubic feet of natural gas. In Europe, I think it's got to be maybe 5. It's come down also because of us already. And in Asia it was 9. Now it's probably 7, 8. So somewhere between 3 and probably where Europe is, at least between 3 and where Europe is at 6. So 450 is probably the worldwide level price for natural gas. And so as we export more natural gas, and as other countries like Qatar export more natural gas, and Nigeria builds more LNG terminals, then the gas where there's a plentiful supply like us will get exported, and that will raise our prices, but the rest of the world's prices will come down until you hit an equilibrium point. So therefore, long term, I think gas should be $4.50. And so if it's at $3, I certainly want to buy it whenever it has any kind of dip. But unfortunately, I'm not sure what SG. Why is volatility? No, I don't. Volatility is a disaster. Everybody tries to play it. It never works. We've even shorted SVXY, which is the SVXY. So the VIX, we figure this is the short volatility. Wait. This is short volatility. So in other words, it's betting volatility is going to be low, and they've been right, obviously, for 2 years. So they bet volatility is going to be low. We shorted the SVXY looking for a spike down if volatility comes up. But because it never sustains a move up, there's no point. It doesn't work. You never get more than a quick dip, and it's tricky to take advantage of it. I mean, it was a nice dip. We had a really nice dip to 68, which was I think that was our target, actually. But because we had a spread, we couldn't take advantage. So I'm sick of it. I don't even want to. Not interested anymore in volatility plays. All right. Now, back to stuff we can make money on. Let's make easy money. Why do you want to make hard money? Make easy money. So we did ALB. Another one for lithium is FMC. And I talked about one. I talked about 2 today that we already looked at. I don't like FMC because, they're 266p. They've gone. They're a big company. Okay, they make $209 million a year. They sell $3.2 billion a year. But for whatever reason, they're being priced at $12 billion. That's a lot. So 5, and then I don't know whether they get 266, but it's really about 60 is the P. Anyway, so compared to ALB that we just looked at, there's no reason to play these guys. And again, $12 billion means lithium is not a big deal for them. Can't be. That's someone profile. I mean, let's see if they even mention it in their company profile. Probably not. No, diversified chemicals, blah 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 blah. Polymer. It's just a thing that appears in their manifest. It's not something really to bet on. Now, I hate to mention penny stocks, but I did like these guys. OROCS. These guys are very much focused on lithium. They're kind of, I think, if I understand correctly, they're kind of a potash company. Potash, yeah. Now, I don't trust them. I don't trust any penny stock, but I don't trust them because they've said developed lithium and potash. Now, most of their business is potash. But they're working very hard, apparently, to become a lithium company. They're even talking about spinning off the lithium part of their company, and they work with not Toyota. I forget the name of them. The people, the Toyota Venture Capital Group has put money into these guys. That's what made me interested. So in other words, Toyota funds stuff that would be useful to them, and Toyota, obviously, with also a great need for batteries, has focused on, hey, who's going to get me some lithium? And apparently, they're trying to work with these guys to develop this mine and build stuff up. So I find them very interesting. There's no money in it. It's a complete gamble, but they're under $1 billion right now, and it's just sort of it's a craps roll kind of thing. But it's the kind of thing where I wouldn't mind putting $1,000 into it, and just like a tiny percent of your portfolio, and just be like, hey, let's see what happens. Maybe it'll be 2,000, maybe it'll be 5,000. Who knows? Maybe it'll be zero. Don't forget that. All right, it could be a 10-bagger, but they're a long way from that. And who even knows? They're freaking an Australian penny stock. So everything bad you can think of an Australian penny stock is probably true. And not only that, they're an Australian company that does their mining in Argentina. So, be very afraid as far as this goes. But, again, I don't think it's a terrible idea. And I think if they are in it for the money and they do spin off the lithium mine in Argentina as a pure play, I think that'll attract people. So I find them interesting, just as a fun sort of thing to do. It's not fun. I'm not putting my money into it. I'm not putting my kids' money into it, but it's kind of fun. If you don't know, I tend to put my kids' money. I like to gamble on penny stocks for my kids. Because, they got time, and if they get lucky, they get lucky. You never know. Speaking of getting lucky, LQMT did not get lucky. The new iPhone is not made out of liquid metal, and they're down from 40 back to 33. But this is one my kids own. One day, they will make phones out of this stuff. Not today. Not the new iPhone, not the iPhone X. There's just everybody's hopes are dashed on this particular round. I didn't think they were going to. They still haven't got a process where they can make enough for Apple to be happy. But Apple does have a relationship with these guys. They keep giving them money to hold an exclusive so that if Liquid Metal ever figures out how to mass produce their stuff, Apple will be the only company that can sell Liquid Metal phones. They pay them every year. They pay them. In fact, that's Liquid Metal's primary source of money is Apple keeps licensing just in case and funding their future, which is a clever arrangement, actually. It'll be so freaking cool. Okay, it's going to cut the weight of the phone down by 20, 30%. It's going to make it more water resistant, more durable, blah, blah, blah. There's so many cool things about it if they can get it right. And it's going to look great. So it's many, many things. And Apple does use liquid metal. Apple's, if you ever get an iPhone, there's a little flat key that comes with the phone for popping out your SIM card. That's made out of liquid metal. They actually use that. So anyway, I like these guys, but they have their usual sell-off. It always happens. They go up into Apple excitement. They were up as high as 40. Now they're back down to 33. I wonder if they have. I don't even know if you can do it on stock charts. LQMT. Oh, look at that. It's like a real company. But as you can see, here's what I care about. It's a nice progression higher and higher and higher. These guys are going to hit it huge. But they're in such early stages, and people keep expecting too much of them, and they run it up for no good reason. This was just excitement, as usual, into the Apple announcement. Now, all it is that this is all bullshit. People think they're going to announce an iPhone with liquid metal rumors. They don't announce an iPhone with liquid metal. It drops back down. And, in fact, this was when, this is when people started releasing what the phone was made out of, the X and all that. Remember, it was before the announcement. Yesterday was the actual announcement. But it bottomed out. I like it because it bottomed out right at the support. It bottomed out right at the 50-day moving average where it started. So all it is back to the normal growth. Slow and steady wins the race in this case. One day they'll announce it for real and things are going to triple up in a day, which is why I like to stay in it. Are we done with this? No, graphene. That's it. I knew I had another one. Now, two graphene plays I like. There's SYAAS. And again, I'm not talking about people who buy product graphene. These guys are graphene miners or whatever the hell they do with it. Graphene is another important battery component. And also, though, there's a lot of high-end materials that are using graphene. So it's becoming a more and more demand situation. So, and again, these are basically penny stocks. Don't make any money, but they are working hard, and they're in the space of graphene, which I really like that space for the future. And the other one is NGP HF, Mason Graphite. Okay, and here's another one. These guys have a little bit more of a business, but they also have teeny tiny $155 million stock. Not Profile Financial. Nothing, no sales, no nothing. Losing $3 million, lost $5 million, lost $3 million, lost $3 million. They're ways from making a profit, and they're probably going to be diluting. So, you got to be very careful buying these things. For them to raise another $3 million, they're going to have to sell. They've only got 100 million shares, right? They got a $1.44 share, $155 million cap. So they got about 100 million shares, and to raise $5 million that they need, or if they really need $10 million, they're going to have to dilute you by 10% just to raise some cash. So that's kind of scary, and so that's Mason and Seurat is also, again, both just little penny stocks, but they're worth watching in the very least. Okay? I'm certainly not endorsing any of these for plays. I'm just saying these are the ones to watch in the space. And that's the research I've done on this, on the battery technology. And if you have good ones, let me know, because I'm very interested in this space right now. SQM we did last week. That's a done deal. We already talked about that. How are we doing? Ugh. Come on, Russell, die. Natural gas is pulling back a little bit. Gasoline came down. See, oil, gasoline came down. Why aren't you coming down? Nikkei, flat as a pancake here. Dollar, see, the dollar's up nicely. So Nikkei, you don't bet against the Nikkei if the dollar's up. Gold came back a bit. Silver came back a bit, but not much. And coffee's still on the tear. So that's where we are at the moment. So let's see if we can figure out what makes the money now. Well, I'll tell you one thing. Okay, if I'm losing money on oil, here's a nice trading tip. If I'm losing money on oil, maybe I can make money on gasoline and also hedge my oil play. So you would think if oil is up and gasoline's down, one of them is wrong. And there's different reasons for it. Like I said, my premise on gasoline was that, and there's no reason oil should be doing better than gasoline. But if oil is going to continue higher, then I would think gasoline would go up a bit also. So if we find a support line on gasoline, which I would guess would be 645, so so way down here is 645. If we find a support at 645, then I might want to start playing a little bit of gasoline for the bounce. Because first of all, if it doesn't bounce, I'll lose a bit on gasoline, but I'll make it up on oil because I'm already short oil. And if we do get a bounce on oil, that will pay for me to add more contracts short on oil, the money I make on the gasoline. But again, I just think oil is basically doing this because it's being pumped up, because of the Saudis said they're going to continue their production cuts. The IEA, the International Energy Agency, they came up with all this bullshit about demand going higher. I don't believe it, and I don't think it'll last. Plus, with oil especially, though, there's a contract rollover pressure. But oil and gas don't tend to stray very far from each other, and this is very unusual that gasoline is down 0.5 point and oil is up 2.2%. That's a big spread between the two today. So one of them is very likely wrong. The question is who? Now, obviously, my bet is oil at the moment. But if oil keeps going up, then I would think gasoline will at least bounce to kind of follow it a little bit. In fact, here, see this? 1045, is the same 1045? Yeah. See here how oil and gasoline spiked down at 10:45, then oil popped back up, and gasoline followed it for a bit, then failed. So whatever people are hearing about gasoline is not good news. And if it's not good news for gasoline, it's hard to say what the good news would be for oil. They shouldn't be operating independently of each other. I don't really want to go long gasoline. I just think defensively, that's something I might want to look at. Now, meanwhile, we talk about when's it a good time to add more positions. Well, I'm 8 short now. It's very expensive if I'm wrong. If I go to 10 at 49.30, I'm at 49, so that's 2 more added. It's 25% added at 30 cents higher. So then divide the 30 cents by 4, which is 7.5. So if I added 2 here, it would raise me to roughly 49.07 on the 8. Well, it would effectively be 10. So is it worth adding 2 more short contracts just to get 7 more cents? It's like, no, not really. It's either going to head down or it's not. And 7 cents, since I need a 30-cent drop, isn't really going to change anything in the grand scheme of things. So it's not worth it. And also, obviously, making 2 contracts worse as I lose. And then not only that, though, but if I add 2 here now, the next time I want to add 2 if I want to add 2 at 49.50, it's going to have less of an effect and dilute the effect of adding 2 at 49.50. If I add 2 at 49.50 now and divide that by 4, that's 50 cents divided by 4 is going to give me 12.5 cents. It brings me up to 49.12. That's at least something. 49.12 is here. That looks kind of impressive, right? It brings me above the last support. So if I add at 49.50, it brings me up to 49.12. If I add at 49.30, it brings me up to 49.07. It's not really worth it. So I'm not going to add anything here. I'm going to watch it. I'm going to wait and see what happens. And there's other factors here also. I'm going to probably go to sleep on this tonight. If I don't win, I'm going to let it ride. If I let it ride, again, I got to start worrying about, wow, at 8 contracts, I'm losing $400 a penny when it goes against me. I'm losing $400 per penny. No, where am I getting $400 from? Sorry. Losing $80 per penny. Stupid. Almost $400. I'm thinking like S&Ps. I'm losing $80 per penny. That's a lot, though. So if the thing moves a buck against me, I lose $8,000. So it's a heavy bet. And I'm not anxious to make it 10,000 and make it 20,000. It's not my goal is to get into such a heavy bet. But I absolutely don't want to let this thing go into Wednesday next week. I must be short oil into Wednesday next week. That's the premise I'm not walking away from. So I will endure pain to do that, but I've got no particular reason to add now, considering if it goes a buck against me, I would add. I'm talking about if it flies up a buck and I don't get a chance to do anything about it, I'll still add and stick with it. So there's no reason to nickel and dime about getting an extra penny out of it now. That makes no sense. See, and everything's looking kind of weak, but not really failing on the index side. And, these guys are pushing on this line. I really need that to fail. Well, obviously I need that to fail. I need it to go all the way back to 21.38. So right about there. I need that kind of fall just to get even on the Russell right now. But I'm sorry, I just feel like it's the right play. I mean, these guys are in the red. The Nasdaq's in the red. The S&P's in the red. Only the Dow is in the green. The Dow is a stupid index. I'm sorry, the Russell and the Dow are in the green. And those are both the silly indexes that tend to fly around. I mean, the Dow you can't pay any attention to. It could be any random component could be making the Dow go up. So it's really about the S&P is negative and the Nasdaq is negative. So why isn't this negative? And especially the Dow seems like the Dow's only 3 points away from turning red also. So wake up, Russell people, and start selling. All right? And once again, though, that goes back to like why I like the NASDAQ short, but it's not cooperating. But now we're going to get another chance to try it because we're getting close to the 05 line, where 05 is right here. I wouldn't mind taking a short again here and seeing if that sticks. And realistically, go 075. So if we can get a short here, we'll start the cycle again and see if we can get lucky this time. And so I got that target, but now I'm going to say I got to watch it and say, well, is this ever going to happen to me? So I'm just got to watch the other stuff and see what happens. All right, so gasoline's getting weaker. Oil looks like it might get weaker. I'm not going to worry about those right now. So back to ES and YM. All right, so as long as now, see, the Dow has a little line here, which is 22,100. So as long as Dow's below 22,100, it's basically weak, and we'll see what it does. The S&P, we can say 24.95 is the line we want to watch there. The Russell, we know we're watching this line. And, oh, damn it, he's all the way down to 3 already. So you finally would have made some money. That was my logic for why. By the time I'm done explaining, it's too late to trade it. But that was why I wanted to get in on the short here, because I really think, again, it's a timing issue. When will it actually get weak? And if you're going to trade the futures, it's a lot of sitting around and waiting for the setup to be just right. And I don't do that because we're doing a webinar and I've only got an hour and a half, 2 hours to talk to you. So I can't really wait 2 hours, but that's what you got to do. And I'll get up at I'll be up at 5 in the morning and I'll watch for a couple of hours before I decide on what futures I'm going to trade. I'm watching the market, and then it usually is because I'll be reading stuff and listening to the news, and then I'll see something or hear something that makes me think something is mispriced. So I'm watching all the futures with no opinion, really. Then I start reading, and I say, well, if that's true, then why is it like with oil this morning? I said, I don't always jump on 8 oil shorts, but my premise this morning, which I was writing in the article, was that oil is very, very likely to go lower between today and next Wednesday. Very, very, very likely. So there's my premise. And I said, well, if that's true, why is oil going up now? And I said, and this morning I said, knowing that we're going to get a big build in oil. There's no question that we get a big build in oil. Apparently that didn't bother anybody so far. But the overriding point of this is that we did get a big build in oil, and oil just continues to go up. That doesn't mean that you should buy it. It means that it's a cheaper short. Oh, see, nobody reminded me. Butterfly. We were going to talk about that. That brings us back to there. So oil stocks are holding down. Yeah, it's all one big circle. Oil longs are, well, good thing for you. That's nice. Wouldn't the crack spread explain some of the divergence in oil and RB? No, that's not the way it works. The crack spread doesn't cause prices. The crack spread is the divergence in prices. That's what the crack spread is. The price of oil versus the price of a barrel of oil when you price it open versus the price of the gasoline that you sell that you make from the oil is the crack spread for the refiners. That's how they make their money. So let's see. TF is trying to get him. Okay. So where are we? Damn, I just said. Oh, portfolios, right. Okay. So in our portfolio review, which was back on the review I wrote the 20th, but the actual dates of the changes were like the 17th, 18th, whatever. So this one was the 15th. So from the 15th until the 18th, we made our changes last month. We are now again in an options expire on Friday. So again, we're going to have to go through this cycle again. So I just want to point out that what we did last time versus this time. So in the short-term portfolio, we were at 393. $493,000. What did we do? Nothing really. In Apple, we actually took the money. What was that? Because we only had the short put. Okay, so we took the short put money and quit. All right. You say, why would we have cashed that out? Leibu, we went more aggressive on, and that paid off obviously very well. Look at that. Wow. So we got more aggressive on Leibu. SQQ, we added to the hedge a bit. TCA, we added to that hedge a bit too. So okay, so we basically pressed our hedges and did that, this and that on those. Now Leibu hopefully made up for some of the money we obviously lost on the hedges. So it was 493, and we are now at, I'll be surprised as you, 477. So down about $16,000. But this was the point I wanted to make. Very, very important. We got very aggressive in the long-term portfolio. Very aggressive with our adjustments. And the reason we were able to get very aggressive with our adjustments is because as of last week, and let's see if I can find the LTP review. LTP, that was easy. Okay. Okay. We were at, what is that? I can't see. 1486. Okay, so let's say we were at 1486, and we weren't happy with where we were. And I wanted to, so in general, we made a lot of aggressive moves. But why were we able to make these aggressive moves? We were able to make the aggressive moves because we have good hedges. Okay? So the long-term portfolio got much more aggressively long, and we went from 1486 to, this is going to be a big number, to, wow, 1618. So $130,000 in less than a month, which is 10% of the entire portfolio. I mean, the basis of the portfolio is only $500,000, so it's like, 25% in a month that we made added to our regular portion. So of the amount we started with, it was a 25% gain for the month, but overall, it's about a 10% gain in the portfolio. So huge up. But why is that? We were able to get more aggressive with our positions because we weren't satisfied with the return we were getting in an up market. So we made aggressively bullish adjustments, and the concept is, worst comes to worst, we'll get paid on the short side. We had huge things. We had very aggressive TIVA play, things like that. We're going to have to cover that. We're going to get less. Now we're going to get less aggressive because now we've got cash. We just made $130,000. What kind of idiots would we be if we don't lock it in? So now we're going to take some of our $130,000, probably $30,000 of it, and add it to our hedges. So we lost $16,000 on the hedges, and now we're going to give them $30,000 more dollars, $20,000 more dollars, so we can lose another $16,000 on our hedges. Because that's what we do with hedging. We lose money. It's insurance. If we never need it, great. We're taking 10, 15, 20% of our long-term portfolio profit and locking it in by buying hedges is smart. And again, we wouldn't have made this money in the long-term portfolio if we weren't so well protected that we were willing to take a chance and go long on these positions. So we made a lot of very low. As I was thinking after we did it, I was like, holy crap, I hope I'm right about this. Because we made a lot of really bullish adjustments last week. And you can, I'm not going to go over it, you guys can go back and read it. But, every single one, more, like that. More Apple, more Taysom, more Chicago Bridge, which went like that since we did it. That's 40%. It's up 40% since we adjusted it. CHK, CMG, Chipotle, we went more, and they stabilized at least. And I wouldn't say they're up, but they stabilized. We added Frontier. We got very aggressive on IMAX. They popped. Everything popped. So it's like, but the point is, because we were down in the trough in these things, we had all these things that weren't working out, these what we call FU stocks that were just like killing us annoyingly. They weren't moving. And our logic was, well, frick, if the whole rest of the market is up and these guys aren't moving up, then they're either due or the market's going to crash. So we buy more hedges in case the market's going to crash, and meanwhile we buy more of these beaten down stocks. We push our money into that, and we get even LB. Even LB moved up nicely. Macy's, Teva. Look at Teva. Holy crap. I don't want to cover Teva too because it's too much. Even UNG made money for a change. So that's how you make $130,000. We got very aggressive, but we only, again, the most important thing, we were only able to get very aggressive because we were well protected by our, in the short-term portfolio with our hedges. And if you don't know how to hedge, you're always out of control. You're always like reeling from one catastrophe in the market to the next. The hedging steadies you up and helps you make much, much better decisions as you move forward. So here's the options opportunity portfolio. That was only 211, and that thing is up. Wow, what a freaking month. It was like, so that's at 214 now. That's a 3.4. It wasn't 211. 311 is 314, so that's up $3,000. That's not incredible, but it's nice. Meanwhile, I think we might have added a trade that I didn't put in here yet. Go see. So we look at all of them. Oh, and the butterfly. That's what I want to see. And in the butterfly, we did some aggressively long plays, which we don't usually do. But again, it was time. It was time to do a few things. So with Apple, we got a little more aggressively bullish. On Costco, we didn't know. We were neutral on Costco. On Disney, we were nope. We were neutral on Disney. No, we weren't that aggressive in there. Sorry, I take that back. Procter & Gamble, okay. Target, 15 of the calls, locking our profits. That's not aggressive. Valero, oh yeah, we did get. I knew we got aggressive on something. Valero, we had great timing. Look at Valero. Oh wait, can't look at Valero. So here's where we got aggressive on Valero, and then it's gone up about 10% since then. So that was a big one for the options, up to the butterfly portfolio. Walmart I said was toppy, and that was here. So Walmart here, I said is toppy, and it has been fairly toppy since. Wynn, I don't know. Well, it was interesting. We set up a new spread to stick with Wynn, and Wynn's gone up nicely since then. But the new spread, probably neutral on the whole of that. All right, but bottom line is, where are we with it? So from 332 to $369, $30,000. So also a very big pop, and that's basically all Valero. It's a lot. It's Valero and Apple, I think, of course, the majority of the pop on that thing. And don't forget, so that's our most conservative portfolio, and it made 10%. So that's crazy. But again, it's because in this portfolio, we don't have hedges per se. Each position is its own hedge. And because we were so well balanced in our positions, we were able to get aggressive on a couple of them and take advantage of the rally. And again, my logic in Valero was the same thing. It was coming into storm season when you have refinery. So, every year we play it like this. And some years it works, some years it doesn't. This year it worked. So we had 60 naked long calls on Valero that made a fortune. I'm 20, sorry. So that's where we are with the portfolios. It's been a really fantastic month. And I point out for the members, it's also been a boring month, right? We haven't done much. But that's the point of the system that we have, is that if you're selling premium and you're well protected, then all you have to do is sit and wait for your money to come in. I think I mentioned in the options opportunity portfolio, we did a review, and about a few reviews ago, I did a calculation to say this is how much money these positions will make. And over the course between now and January of 2019, we calculated what each position should make. And those positions, at the time, probably I think before the summer, I think we expected them to make $150,000. At the time, we were at maybe, probably 250 or something like that. Now we're at 314. All it's doing is what it's supposed to do. We sell all this premium, and then as time goes on, as long as we're in our target range, all the premium disappears, and we're left with our positions. And if our positions are good conservative positions, like look at Target. We bought the calls at 40. We sold the calls at 52 back in June. And we sold some puts. This is what I meant by the premium. All of this is premium. So right now, at the time, I don't know what it was, but all this is premium. $1,000, it's all premium. Target's nowhere near $45. So as long as Target stays where it is, we're going to make $1,000. The January 40s with Target at 59 would be worth the 40.52. So the most we're going to get on the spread is $12.50. Currently, they're at 1975, but 1975 minus 975 is 10. So anything less than 10, which is 250, is premium that's going to wash out of this position. So here I've got, it's not 10, it's 7 for some reason. But here I've got, let's say, of $2,000, let's say about $2,000, $1,500 to gain here, and $1,000 to gain here. So, in other words, by January 2019, as long as Target is over 52.50, this position will make $2,500. And currently, it's tying up 5,000 minus 3,000 plus 1,000, so 3,000. It's tying up about 3,000 in cash, and it's going to make $2,500. So it's still a good position. So anyway, that's the math I did at the beginning of summer, and by doing all that math on the OOP, is it the OOP? Use that. Yeah. By doing all this math on the OOP, what we said is we're going to make another, now a lot of it was Apple, but we said we're going to make another $150,000 between now and 2019. And so far, we're totally on track. But we haven't done a lot of trades. It's almost boring. We're so well set up now. We're so well hedged. We're so well balanced that it's pretty boring. And there's not a lot of changes to make. Because, every once in a while something comes along. We've added a couple of positions in the last month. But it's getting kind of dull. Because this is one of the reasons I would redo the portfolios. It would just get boring because you get to this point where your portfolio is built up over 3-4 years and it's performing properly, there's not much to do. You just collect the money. But boring is good when you're investing. We don't want to be exciting every day. We just want to be here and tend to our garden, basically. We just want to, we trim a little thing here, we crop a little thing here. I think one of these guys, we sold something off to cash out last week, a couple of things. Every once in a while you say, okay, that's run its course, go to cash. But Target, for example, it's only tying up. I don't need margin. I've got $193,000 in cash. I don't need margin. So Target is only tying up. I'm sorry. What do we say was $3,000 in cash, and it's going to make $2,500 in 16 months. Well, that's good money. That's a nice return. So you leave it, and that's unfortunate. That's what you do. You leave it. We leave it. We have so many positions now that we're not touching. And we're also, and again, we're so well hedged, and we have hedges in this portfolio. Mostly FQQ, I think. We have TZA, FXP, and FQQ are our hedges. So in the options opportunity portfolio, it's self-hedging. It has its own hedges. The long-term portfolio and the and the short-term portfolio are paired portfolios. The short-term hedges for long-term, and the butterfly portfolio is also self-hedging. But when you got them right and you balance them correctly, first of all, it's not in your interest to mess around with it. Hey, you don't want to mess around with it. You just want to leave the positions alone and let them make their money. They're set up properly. That's what they should do. They should just keep dropping money into your lap. Some months better than others, but in general, the trend is going to be more money, more money, more money. And why? Because we're selling a lot of premium. The premium will expire. It will be zero. Every penny of premium you sell will be zero when it expires. So sell it. Sometimes you'll be right. Sometimes you'll be wrong about the position that the premium is being attached to. But basically, I mean, I don't know the concept, but when we sell premium, we're taking a bet on a coin flip, heads. So the premium is 10. Let's say the premium is 10%. So I'm going to take a 10% premium, and I'm going to bet heads and tails. And I'm going to pay you even money if you're right. But you have to bet me. You have to bet me $1.10 to win $1. You're paying the premium because you're the one making the bet. So yeah, sometimes I will win it. Sometimes I win $1. Sometimes I lose $1. But every single time I keep the dime. Who's going to win in the long run? I could go on a streak. You could get 20 in a row, and I could be down $20. As long as you keep playing, I'm still getting a dime from you. You're 20 in a row while you won $20. I collected $2 in premium, and one day it'll go 20 in a row in my favor. It doesn't matter. As long as over time it's an essentially even transaction, I've given myself a 10% advantage. That's what we do when we sell options all the time. We're giving ourselves a massive advantage in the market. And as long as we manage to balance our portfolio, it's almost automatic that we're going to get winners. So the key is to balance and hedge and avoid the catastrophic loss, because as long as we are there to play, we're always going to keep making money on a regular basis. All right, that was a very important point I wanted to make today. All right, so how are we doing? Making money, losing money? No good. Now he comes down, you bastard. Just the only time I didn't play it. All righty. And how's oil doing? I don't even want to look. Nope, still hanging out in the same place. All right, well, no excitement there. Any other questions before we go? Let's see. We have a new, we have to have one soon because Friday it expires. So, yes, I promise. 20 in a row, the Cleveland. Yeah, 20. That's right. That's what I was thinking, 20 in a row. Yeah, Cleveland, 20 in a row. 21. It might be 21. Wait, they have an afternoon game, right? So this is it. This is a biggie. But the Cubs don't actually have the record. They say the Cubs have the record, but the actual record was held by the Giants in like 13. They won 26 in a row, which is amazing, but there was a tie in between. So there's like an asterisk to their streak because their streak had a tie in the middle. They didn't actually win every game. They didn't lose for 27 straight times, but they won 26 without losing. So it depends what you want to call a streak. That's amazing. And you know what's funny about it? They were terrible. They weren't even a good team. They finished fourth, I think, that year. They wasn't even. It was just for some reason they won 26 in a row. But I think they probably won. It was a short season. I don't think they probably were even a 500 team for the year. That's crazy. That means they must have really sucked the whole rest of the year. Anyway, hopefully I won't suck the rest of the year. I am really, really hoping that by next week I'm going to be very proud of my oil play and my wrestle play. And we'll see what happens, all right? Thanks a lot, though, for coming, and I'll see you guys again next week. Take care.